Hi, my name is George Dagnino. I'm the editor of the Peter Dack portfolio. Are we in a recession? A lot of people have been forecasting recessions for at least the last 2 years since 2022, actually. But recessions happen for a reason. Don't just happen. The recessions are happen to correct previous mistakes. So what I would like to do is to show you all the indicators, the most important indicator, not many, and show you how they behave during a recession and why. So now you will learn, if anything, why we are having or not having a recession. This is a classic business cycle, and the crucial point is the transition between phase 4 and phase 1. At the beginning of phase 4, what you have is business has very lean inventories and waiting for resumptions of demand from consumers. Of course, consumers now at the end of phase 4, they are stretched. They don't have much money to spend. However, in phase 4, inflation starts decline, interest rates decline, commodities decline. So the purchasing power of consumers improves. So they start spending at the beginning of phase 1. As I said, business has low inventory, so they have to start production. Starting production to replenish inventory so they can sell them. Now, what happens is, of course, more inventories, more production, more people, more raw materials, more interest rates borrowing. In phase 2, things are stretched. Business is ramping up production, commodity prices are rising, they have to borrow more because of working capital requirements, they have to borrow to improve capacity, so interest rates rise, inflation rise. All these things happen at the end of the phase 2. This is where the turning point happens. Too much demand, too much rising commodities, employment and wages rising, inflation, interest rates rising, consumers start slowing down demand. Business does not recognize this slowdown. They think it's transitory. However, the slowdown is for real. Consumers slow down demand. Business start losing money because they're piling up inventories and they're losing money for inventory carrying costs. So production is being cut and inventory starts slowing down until when? This is the crucial thing that where we're trying to answer the questions. Are we in phase 4? Why does phase 4 happen? Well, we said the crucial point was that consumers are running out of money. Inflation is reducing the purchasing power, so they slow down demand. So when will consumers improve and start buying houses and go out on a spending spree? Well, when the things that cause the consumers to retrench are brought under control, which is what? Inflation has to come down, interest rates has to come down, and on the business viewpoint, employment cost and overall cost of running a business have to come down. Only then will consumers start buying stuff again, and employment and the economy growing. So the problem, what I'm trying to answer with this video is, okay, are we in phase 4? And at what stage are we in phase 4? This is where the recession takes place. Let's look at the data. Since 2022, inflation has been rising more than 33%. What that means is our income has been reduced by 33%. That's a lot of money that we lost in the last 3 years. So what happens to consumer purchasing power? Has been declined dramatically. Where is this best seen? Well, in the orders and spending for durable goods. Durable goods are the big ticket items, furniture, refrigerators, that kind of stuff. So that have a lifespan of more than 3 years. Look what happens to durable good orders now. They have been, this is a rate of change, by the way, so they've been over 12 months. So they are really declining. That confirms that consumers are not buying big ticket items, and business is not receiving orders. Now, the important thing in all these charts, I'm going to show you the previous recession of 2008 and 2020. See, this is declining, and this is exactly what you see on a recession. The first thing that consumers do is cut big ticket items, and business also do not receive orders. But don't jump to conclusion. Don't jump to conclusion. This is one of the data that say, yes, we are probably very close or into a recession. As you can compare this data here to this data here. The gray line is a recession. Let's see what the other data are saying. This is an important chart. It's very, very important because it reflects the effect of the huge amount of money printed by the government to support the economy. This is income and sales in real terms, that is after inflation. As you can see, during a recession, the rate of change goes to zero and becomes negative because income and sales after inflation is declining. Remember, inflation declines and has an impact on income. Right now, real income and real sales are growing at around 1.5, 2+%. So there is money flowing into the pocket of consumers. This is very, very important. You cannot have a recession, or at least it's very rare to have a recession without a contraction in income and sales. And right now, it is a fact that those two indicators are expanding at a nice clip. By the way, very close to the long-term average, which is around here, around 2 to 3%. These data are for employment, temporary and full-time. And as you can see here, during a recession, the rate of change, I'm measuring most data in rate of change, which is important. So as you can see, the rate of change here is negative. You see there is a gray line in employment, temporary and full-time declining. This is the same thing in the 2020 recession, and this is what has been happening now. The full-time is slightly negative growth, and the temporary are contracting. So the employment is saying, well, it's not as dramatic as here, but employment numbers are saying, yes, we are more likely we are already in recession than not. But again, don't jump to conclusion. There is no question about that during a recession, industrial production declined, like it happened here during the 2007-2009 period. Why? Because business is cutting production because sales are slowing down and inventories are accumulating. Right now, sales are not strong, as you have seen in the previous slides. So production is basically flat, has been flat for the last couple of years. Why? Because with sales very sluggish, business has learned from the previous recessions not to build up inventories. So they're keeping production low enough to bring enough inventories to satisfy the slow growth in sales. So this is not what happens during recessions. If we were in recessions, we would have this kind of decline in the rate of change, meaning that business is aggressively cutting production. This is not what is happening now. So far, the economic data are saying, yes, the economy is weak, but it's not, the data are not convincing us that really we are in the middle of a recession or at the beginning of a recession. If nothing else, income and spending are still growing at a nice pace. Models from the Atlanta Fed and the New York Fed are saying we are growing at 2.9%. So the economy is strong. So why not strong, but I mean it's hanging in there, but it's not definitely not in a recession or going into a recession. Even employment, yes, is weak, but is not that weak. So now let's see what are the financial data are telling us if we are in a recession or heading into a recession. The first thing is the yield curve. Everybody is saying the yield curve is inverted, meaning that the difference between the 10 and the 3, I use the 10 minus 3 yields, is negative. Therefore, you see that before a recession. That's not true. Yes, when it's negative, eventually will come a recession. But the time the recession comes is when short-term rates decline relative to long-term rates, and the yield curve becomes positive sloped, meaning that the 10-year yields is greater than the 3-year yields. This is exactly what is happening here. You see, it was inverted before 2007, but then short-term rates decline, the yield curve steepen, and you have a recession. That is, the recession is the expression of short-term rates declining because business is not borrowing anymore, because they're cutting production, they're cutting inventories, they don't need more plants, they don't need to expand, they don't need to hire people, they don't need to buy raw materials. So borrowing declines and short-term rates decline and the yield curve steepen. But this is not what is happening now. Right now, the yield curve is inverted. Yes, it's deeply inverted. Yes, it means that there is some kind of credit issue. Yes, but it doesn't mean that the economy cannot go for at a very slow pace for much longer. So the yield curve, as far as I'm concerned, is not negative. It's just saying that there are some credit issues out there, but right now they don't have reached dramatic negative trends. If they were negative trends, we would see this kind of upward direction in the yield curve. Well, in a recession, or just before, well, actually during a recession, what happens is first commodities decline just before a recession because they're very sensitive to the fact that business is cutting production and is buying fewer raw materials. Then eventually interest rates decline as well. What has happened in history? This is what has happened. The short-term rates decline and commodities decline. This is what happens when the economy slows down and eventually goes into a recession. Now, right now, yes, short-term interest rates, the green line, have been declining, but not like this. So this is what happens when you are entering a recession. This is not the case yet. And when commodities are, when we are in a recession, commodities don't trade this way. They go down big time. They really go sharply. So yes, the commodities and short-term interest rates, they're telling us, yes, the economy is weak. That's the main theme so far, really. The economy's theme is weak, sorry, but we didn't see the decline in commodities and in short-term interest rates that we are really into a major recession. This is not the case yet. Well, we said that one of the important things, the major reasons we enter a period of slow growth and eventually a recession, it depends on the rate of inflation. And right now because the rate of inflation, really what it is that declining purchasing power. Right now, as I said before, from 2022, our purchasing power has declined by 33%. That's a lot of money. 1/3 of our income is declining. And what happens, the consumers retrench, stop spending until if inflation declines, thus improving the purchasing power. This is what happens during a recession. The recession comes, and then inflation, all these numbers, I will tell you what they are later. They all decline because all prices come down, because the inflation consumers are on a strike. Now, what is the most important number? The most important number is the black line. What is the black line? The increase in home prices. They lead, as you can see, before the recession, they decline because the first thing that consumers do when they're running out of money is to cut the big ticket items, not only refrigerators and and furniture, but also the whole home. They stop buying homes. So prices have to come down so that it becomes more affordable. But look at what happens now. Home prices are still, this is the rate of change, is still growing at more than 5-6%. So this is not, inflation is not under control. It is true this data are 2 months old. However, the lead that they have, look at here, relative to the other inflation measures, is pretty long. So the fact that home prices are still going up at that pace, it doesn't mean that inflation is under control. This is so the consumers are still feeling the pinch of declining purchasing power. Ahead of any recession, there is a credit event. A credit event means that some banks or some business are running out of money and they cannot repay their bonds, their obligations, financial obligations. In that case, what you see is the yield on the corporations that are in trouble increase relative to treasuries. So the spread is increasing. And this is what happens before the recession of 2007, 2008, 2009. The spreads between high-grade bonds and or lower-grade bonds and treasuries started increasing. And that's what happened. There is a credit, the financial markets freeze, and the economy gets into a recession. And that exacerbates the fact that consumers have lack of purchasing power. This is really what happened too before the 2020 recessions. Every time you see this uptick, and I show with my business cycle indicator, there are minor business cycles that go rise and decline. I will show you more in details what I mean later. So these indicators are very important and very sensitive to economic conditions. But the bottom line is, if they rise, there is a credit event or credit risk is rising. But as they decline like they are now, there is no credit risk out there. What does it mean? It means that there is a lot of money. There is money enough not to create problems. And this is positive for the economy and for the stock market. These data come from a survey by the Federal Reserve. The Federal Reserve every quarter samples, has a survey of the major banks, and they ask if they are tightening lending standards or not. In other words, are they very careful in lending money, or they make it easier to lending money. Make it easier lending money means that they don't mind to encourage lending. They decrease the spreads between the cost of money and the money that they lend. So what happens? What is the output of this survey? Well, you can see that before a recession, I told you there is always some type of credit event and credit spreads increase, and banks start increasing. More and more banks increase lending standards. And that's what you see ahead of a recession. When they lower lending standards, more and more banks lower lending standards, it means there's a lot of money and they want to lend you money, and they will try to encourage at any cost to lend you money. So it means that everything is okay. By the way, this is when there is a bear market, and this is when there is a bull market. Look at what happens now. Yes, we had an increase in 2022 when everybody was looking for a recession. That was one of the reasons. But look what is happening now. The majority of all the major banks are easing lending standards. There are fewer and fewer banks that are raising lending standards. So this means that there is a lot of money. And by the way, this trend coincides with the lower credit spread. So this is very positive for the economy and also for the equity markets. Equity markets always rise during these periods and during these periods and during these times as well. What about the stock market? Well, this is an important chart. It shows the S&P 500 is the top panel. In the mid panel here shows the percentage of stocks above the 200-day moving average. And as you can see, the current percentage is fairly high, is in the 70% or above, meaning that there is a strong momentum. The lower panel shows our business cycle indicator. How do you read that? You read it by saying this is the economy strengthening and this is weakening. Strengthening and weakening. And by the way, as you can see, these trends also correspond to these waves here. Like this is very similar because the market follows very closely the business cycle indicator and vice versa. So what has been happening right now? That there has been, since 2023, a strong economy. Now the economy since 21, 22, 23 has been slowing down. The market has been changing its profile, its structure. From cyclical is slowly becoming more defensive. This is what this decline in our business cycle indicator. It also says that the market is not going to do much progress in the averages. And in fact, you're already beginning to see the transition that has been happening from cyclical technology into more utilities, healthcare, real estate, and staples. So this is what this indicator is saying. Now, what about when is a good time to buy? Well, a good time to buy is when this line is here, down here. So there is momentum. This one is say the transition is declining. This is when is a good time to buy. This is when is a good time to buy. But the fact that the business cycle indicator is slowing down means that there is a transition in the stock market that we should be keeping into account. So where do we stand? Well, we in the Peter Deck portfolio, I've been telling our members that the economy is going very slowly. There are pluses and minuses, but the fact that income is growing and there is no financial risk, as shown by the spreads, as shown by the amount of the banks decreasing lending standards, they're all signs that there is plenty of liquidity. And with income and spending rising, yes, the economy is not in a recession. However, there is clearly consumers are in deep trouble, so to speak, because the decline of more than 30% of purchasing power is huge, as shown by the weakness in durable goods spending. So yes, things are not good, but they're not also bad. And this is what the business cycle indicator was saying. So what did we do? Well, we told our members what we're going to do is shorten our investments. So instead of, our portfolio is around $360,000, something like that. We take a big chunk in money market, but around $40,000. I don't even know that we put 50. We invested in stocks. However, the investment is a model that I follow that is short term. Could be a week, could be 2 months max. And I discussed this in several videos. So and it turns out that it's been quite successful. As you can see, these are data provided by Schwab, where we have the gain-loss ratio of 75%. We have the number of transactions that are positive are 71%, more than 71%. And this is the bubble chart of all the transactions we made since the beginning of the year. This, of course, are the positive one, and this is the negative one. It's turning out to be a good strategy. We are not risking money, but we're still making some money for our members in a prudent and very quick way. We have three levels of membership in our Business Cycle Academy. The membership, the first level, you just receive and available videos that like this one. In the second level of membership, not only the videos, but will also every time there is an important economic indicator being released and has an impact on the markets or on the investment strategy, we publish a short note to our members. On the membership level number 3, you have all of the above and plus the Peter Deck portfolio, which is a 22 pages report twice a month. Well, I want to thank you very, very much for following this presentation. I hope you found it useful. And of course, if you want to dive deeper into the content of analysis, studies, recommendations, especially we have two model portfolios, two sets of portfolio. One is based on ETFs, which has a tremendous records, not as much as performance, but as much as very low risk. So they provide a nice return, but with very low drawdowns. And of course, we have the model portfolio of equities. And every time, by the way, we make a transaction, we tell our members what is the transaction, either buy or sell. Well, thank you very, very much again, and I hope to see you really, really soon. So long. Have a wonderful day.